This is not some piece of like new evidence. This is literally a manufactured story from the future.
There comes a time in every credit cycle where the money, the lenders, the investors, where they say, no more.
I drew this line right here, and this is when that AI End Times article was written. And so it would be kind of a fascinating thing if that actually marked a bottom.
The dirty little secret is that equity markets go up where governments are spending money, right? I mean, that's the reality. And governments are spending money all over the world now.
My least favorite phrase is the easy money has been made. You hear this on CNBC all the time. They're like, the easy money has been made. And I'm like, bro, there has never been easy money been made in markets.
The world is a series of probabilities. There's a bunch of different outcomes. Each one has a probability. We have no idea which one we're going to get. Let's think through the range of all the different outcomes, and then let's try to just think about how that impacts us as investors. So Matt, do you think it's fair to say that Last Call has taken the investing world by storm?
I not only know for a fact that we've taken the investment world by storm, I'm disappointed to let you know I left on the private jet when I just got off there. I left
You did.
the custom cocktails we had made in celebration coming into this second show, after a couple of 2 drinks. We had those blueberry citrinis. It was like a blueberry citrus martini combo in honor of probably the
Citrini,
yeah. We've taken the world by storm, right?
We have. I mean, maybe like a light ream, maybe a little bit of like. Can you work with that? You're kind of the marketing guy. So can you take like the investing podcast that's taken the investing world by light ream? Can you work with that?
We've taken the world by a misty haze.
Yeah, exactly. I mean, that's probably accurate based on the views in the first one. So can you work with it?
Is it misting or are you just sweating? That's the story of my life. And man, are you?
That's kind of where we are right now on the taking the world by storm. But maybe 4 or 5 episodes in, we'll have that done.
So Citrini, I feel like took over my life for the last week, and is certainly the bow on the top of the month because it fits into every other conversation. I feel like we're having where were you and when you first read the Citrini piece or realized you'd have to be talking about this?
I mean, think about the people that have responded to it. Like Citadel decided that they needed to write a response to this. Like Jeremy Siegel was out this morning with a response to this. Like the Governor Waller on the Fed was talking about it, responding to it. Like it just shows. I mean, it shows the power of the internet, and the power of writing a certain type of piece. But yeah, I mean, everybody is talking about this thing.
Especially for what is stated at the beginning of the piece is basically like a science fiction bear case exercise. This is not some piece of new evidence. This is literally a manufactured story from the future, theoretically looking backwards, which I also find just mind-boggling, especially when we get responses from some of these people, because it's like they're responding to fiction. And that's kind of amazing that we're all on record now responding to fiction.
I can just imagine, the first thing I think of, as you can imagine with me, is I'm like, how many Substack subscribers did he gain from this? Because it's got to be it's got to be a massive, massive number.
Yeah. And this is everybody's on, you see small versions of this all the time. You see the Mike Green's, when he puts out his piece, which factually people then obsess over. So he gets the biggest push. A bunch of people obsess over it, ride the coattails for stuff and pull apart details. In the end, we all agree, hey, he was directionally pretty right. And that it costs more than it used to, which is a simple and obvious observation. But lots of people in the ecosystem ride the coattails. We are firmly in the coattail riding thing. I wonder how many YouTube views, how many new Substack subscriptions some of these people have gotten. I don't know if we're going to get any of that bump here today. But any big takeaways for you? Did the piece inspire?
Yeah, I think people take these things all completely the wrong way. I think when I read these things, my reaction is not this is the worst piece that's ever been written, or that I agree and the world's going to end. There's always something you can learn from this. And I learned a ton from this, not in terms of what's actually going to happen, but in terms of thinking through the progression of AI, and AI from the perspective of enhancing labor, enhancing the ability of workers, but also AI from the perspective of replacing, and the balance that we're going to face with that. So to me, it was, and we did, Kai Wu and I did a separate episode that'll come out the day after this, where we spent an hour breaking this down. But to me, this is a great learning experience because it forced me to think about this scenario. Even though this is a scenario, I think Citrini would even tell you, it's probably not going to play out this way. If it does, it's probably not going to play out nearly this fast. But nonetheless, like just thinking about the extremes sometimes like helps you learn about the reality.
We've said it a million times. Risk means more things can happen than will happen. And I believe even Citrini in this case would tell you this is part of a bear case scenario planning tool. And that's what's so, I'm going to say it, that's what's fun about a piece like this. It's kind of fun.
Having fun with the bearishness, man. I like
I'm having fun with the bearishness. Put some explosions and some fire around me. Because I look at this and I go, I've been taught extra Michael Mauboussin, extra expectations investing, and thinking about what's in a price. You should have a base case, a bull case, and a bear case, and maybe put plurals on all those. Have base cases, have bull cases, have bear cases. This is one strand of the spaghetti noodle in the whole pot that we're pulling out and going like, this one's undercooked and maybe a little moldy or whatever. This is a bearish bear case that's in the mix. But at the end of the day, when we're thinking through, and me with my planner hat on especially, it's like AI and this build out is all these tendencies of an inflationary shock inside of it. But on the back end of it, if these tools are really for real, there's a giant disinflationary element too. And that's a hard scenario to plan over that curve of being like, these are all the things that are probably going to push prices up in the short term. And then these are how far prices could come down in the far term. And here we have this wild scenario that takes into account demographics, ghost GDP. I love that word. Definitely didn't know that word until this report.
Yeah, I'd never heard of that.
Love ghost GDP. You know, send them a Pulitzer for that one. But how cool is this to have all this other cool color around the scenario? I think I'm with you. It's neat that they did this.
And we've never had a technology that was a replacement for human intelligence, at least in part. And so nobody has any freaking idea. Like you can see all these economists and everybody's writing all this stuff. Like the reality is like you and me who are unqualified to talk about this have just as much of an idea as those people do in terms of how this is going to play out. We don't know. And so when you don't know, I find the best thing you can do is what you said, which is realize that the world is a series of probabilities. There's a bunch of different outcomes. Each one has a probability. We have no idea which one we're going to get. Let's think through the range of all the different outcomes. And then let's try to just think about how that impacts us as investors. Like, I think that's the only thing you can do. And this helped me like on the bear side in terms of thinking about that probability, because he worked it through it in the story in a way like I hadn't worked through it before.
In a story. And that's the key part of it. He worked through it in a story. It was memorable. It stuck. It kinda, sorta, a little bit seems to have moved markets. So it's our market recap. We're looking back over the last month and things that happened. We tapped some of the smartest people we know to come in with us and actually look sort of in the wake of this, which they all did. We didn't even ask them to. Everybody came to the table with at least a hint of Citrini and what they were talking about. I know you had Brent Kochuba up first. Just give a little preview before we play the clip, because Brent walked through what I'm assuming dealer flows and everything else for how this played out.
Yeah. What's interesting about this is we're all talking about our opinions, but what Brent sees is what people actually do with their money. He sees pricing inside the option market. And so that's what we talked about. We talked about this idea of this Citrini piece came out, all kinds of crazy stuff went on in terms of the pricing of options, particularly around these software stocks. So I sat down with Brent and he's got a great 4-quadrant chart here where he can talk about what's going on with these software stocks and also the way people are differentiating between them. It's not like all these software stocks are in one spot. So this is my conversation with Brent. Brent, welcome back to Last Call.
Thanks, Jack. I'm super excited for you about the show. I'm super excited to be talking to a person and not some AI for a few minutes. So that's nice as well.
Yeah, well, I thought you were going to do a little announcement at the beginning of this that we're having a 50% layoff here at our options podcast, and you've decided to go with an AI host going forward. So
that's right.
You know, we'll see what that means for like labor productivity, the economy, and all that stuff in the future. But really, I mean, what do? I tell a couple of bad jokes and then I move on with my life. So you could probably do that with AI, no problem, right?
Your spirit can't be replicated by AI, Jack. So
I hope so, because I want to still be employed when this whole thing comes down.
Yeah,
you know,
we're all gonna die is the headline apparently. From
yeah. I mean, hopefully we don't see the reality of the Citrini piece playing out. And we won't get into that too much because I know people don't want our macro takes. But what is interesting is you do see what goes on behind the scenes. With all this stuff. And you know, one of the things before we get started here, I want to point out is I did notice I was just scrolling through Twitter the other day and I was like, Brent is going viral over here. Like it's very rare to see a tweet and then see the comment to the tweet actually get more views than the tweet itself. But we've seen some misuse of the put call ratio. Is that what's going on?
That's true. And I don't get a ton of like Twitter likes persistently, but this one I did for me get a decent amount. For some people, this is like eating popcorn. You know, it's just another day. But the chart, the chart that is offensive, and I wonder if how much this is SIBO is AI doom stuff, whatever. But this is the chart, and so this is the fella here, and he wrote that this is very scary. But this is the chart that he posted, and he said that, do you see this? S&P dump, S&P dump, S&P dump, and he circled all the dumps. So what do you notice about these circles here, Jack? What do those seem to correspond with?
It seems like he circled the absolute bottoms, Brent, every single time.
And then he spelled Fukin, I think, wrong. Whatever it is. The point is that this seems to correspond with stock market bottoms, actually. And incidentally, there's a little bit of data to support this. And so he did call out something interesting, that this ratio is extended. This, I believe, is a single stock put call ratio. But, you know, the problem with this is, and I'm getting all these people saying, how do we hedge the Middle East war and stuff like that? I looked at Polymarket. There's not like a big spike in people thinking that the war is going to take place. Maybe because insider trading on Polymarket now has been taken out. I don't know. But if you look at where the S&P has been trading, Jack, I don't know how well you can see this, but do you know how far back this sort of range goes? I mean, this is 6,800 to 7,000. You have any idea how far this goes back?
I don't. No.
That's Christmas. So
Okay.
in the last 2 months, we've done nothing in the S&P 500. Today, futures were down 1%. And like, finally, this is the moment. Iran war, this, that. Hopefully none of that happens. And then the S&P just kind of bounces. So, you know, if we break 6,800, then I think you got to like do the famous roaring kitty lean forward thing. But at the moment, we're just trading in the range, and it's kind of boring. It's decent if you're like a call seller and playing those ranges is cool. But, you know, NVIDIA earnings didn't really spark anything. And so that leads us to, there's really only two interesting stories. One is gold and silver is doing pretty well. But the second one is software, which everybody and their brother and their mother and their bot is talking about. And so I think we want to touch on that a little bit.
Yeah, did you see anything? I'm just interested, like the Citrini thing. I mean, it was weird to see, like, to actually see that as a Bloomberg headline, like Citrini piece sparks market sell-off or whatever it was. Like, was there anything you saw crazy in the S&P or like anything at all, like behind the scenes in options when that whole thing was going on?
It moved options prices. Some stocks like American Express, we're talking about, MasterCard, definitely seem to have unusually high volatility, but there was no put buying, no signal at all in that options data that said this sparked actual fear. And what I think is actually kind of interesting about this, Jack, you bring up IGV. IGV is the iShares Tech Software ETF. So a lot of the names that were kind of pinned in that article show up on this list. And if you kind of just zoom back a little bit and look at this, I drew this line right here, and this is when that AI End Times article was written. And so it would be kind of a fascinating thing if that actually marked a bottom. And in a way that almost kind of makes sense, right? It's like, everybody sort of knows this trade. Everyone's talking about how the trade is you know, on to short these things. And this is also a level in this index. I think you're more of a certified market technician than I am, but you know, this has been a level where these software names has sort of bounced. And a lot of those names are reporting earnings this week, which is also interesting. And in fact, on that point, Salesforce, CRM, they announced a $50 billion buyback, which I don't know if they feel like they're about to get nuked by AI. Would they do that? I'm not sure. You're the fundamental macro analyst when we talk, so I'll leave that to you to parse through. But it is an interesting moment where maybe that marked the short-term bottom.
If I'm the technician of the two of us, Brent, we're in a whole lot of trouble over here. We basically got the value guy and the options guy drawing lines on charts.
That's where we start. We haven't.
It does look though. That's a very. You don't have to be a chart technician to figure out that line has been a pretty consistent bottom.
It has, and maybe this time is different. Of course, you know, the last 2 weeks have been bananas in the AI space. Like the tools coming out are crazy, and I think it's hard for everyone to sort of pick through. But what we like to talk about oftentimes, Jack, is options prices and positions, because we can talk however we want about the way that AI is impacting our lives and everything like that, but are you actually trading off that, Jack? Are you going all in short S&P because you think we're about to hit a 30% drawdown, recession, depression, whatever? Or are you just saying that, right? If you buy an option, or if you buy a put, we know that you have some conviction, or you at least want to hedge something. If you buy a call, you're betting on the opposite, right? So that shows up in one of two places: options positions, which we track, and then also prices. And so we talk about this Compass scanner a lot in our monthly OPEX reports. And what this just shows you is options prices on a relative basis. So what I mean by that is if options prices are pricing in extreme movement, you're at the top of this chart, so high IV rank. Low movement is at the bottom. So when you're really scared, or if you're uber bullish, like because we all got to buy silver or gold or whatever, that's at the top of this chart. And then left versus right. On the left, people are more into puts. On the right, people are more into calls. So top left is as bearish as you can get. So Adobe, ADSK, as bearish as it gets over the last year of data. You can see the IV rank there is a 95%. And the risk reversal rank, which is the weighting of the put versus call, is a 9. So people are really into puts, and that implied vol, or the estimate for them, is extremely high. Now, two things on this, right? Both of these names are going to report earnings. That's what this little red E is. And so why does that matter? It matters because we know that when earnings comes out, volatility usually comes down, and you get clarity on these names, right? Meaning Salesforce says, hey, $50 billion buyback. That doesn't seem terribly bearish. You even have a situation where, like Into, for example, they reported yesterday, stock last time I checked was down about 3-4%, which is okay amount. But these stocks are pricing in, 8 to 10% moves in perpetuity. And so if you get anything less than 8 to 10% moves, then that volatility comes in a little bit, right? That shock comes in a little bit, and that could be supportive for these stock prices. And so that's ultimately what I think here is we have this extreme bearishness, and at this point, the stock's already down 30%. So how much more bearish are you going to get here to justify how expensive these options are? And I just think that as that sentiment normalizes and these options prices shift a little bit lower on this chart, normalize, mean revert a little bit, that could help with these stocks bouncing a little bit.
Two things. One is what's really cool about this is, like, we always talk about, like, the market fears this or the market fears that. Like, this chart is like what people are actually doing, which I think is really interesting. Even for me as like a long-term fundamental investor, like, this is telling us what people are actually doing with their money. Like, that's fear. Like, if I'm buying puts, that's, to your point before, that's real fear. Like, if I'm just talking about it, like, that's not much of anything.
Yeah, and that's 100% right. So what you can see here is I refresh this and I put the last 3 days of history. So there's a lot of lines on this chart, but the lines show you the path. So CRM, for example, they reported yesterday, and you can see that into their earnings, it's a little tough to see. They were up in this area here, right? Extreme bearishness. As bearish as it's been in the last year. Remember the tariff tantrum in April, which is we weren't sure the financial system was going to survive that, and those were some legitimate fears there, right? So we went through that period, was in the last year of ranking. So these are more bearish, or were more bearish than that period. And now that CRM reported, you see that vol come down now, right? So the options prices have lost a lot of their elevated pricing. They've gotten a lot cheaper on a relative basis. And that tells you that fear is subsiding a little bit. That event is out of the way. So now maybe you can see a little bit of normalization here. You're not seeing people piling into calls yet. And so, ultimately that would be the little bit more of a bullish sign, but that fear, or that sort of peak crisis, kind of the point of the IGB chart we were looking at before, seems like it's coming down. And again, you have Adobe reporting next week, as well as ADSK. And so that can just sort of let the whole complex just sort of breathe a little bit. And maybe that generates a little bit of bullishness in a market that has had a hard time finding a bullish narrative, quite frankly.
Yeah, just as we wrap up, one other thing that's interesting to me about this is there's this narrative that, like, all software stocks are in trouble, they're all going to fall apart, and, like, what you want to see, I think, to some degree, is differentiation, and you're seeing that here. Like, people are reacting differently in the options market depending on what's happening with that actual business, not just what's happening with software stocks in general.
That's right. It can be hard to parse this stuff out, and I was thinking about this too because we all want to catch the ultimate AI investments as that grows, right? And is that the memory space or GPUs, or, what is the sector you want to go into? And if you can look at those options flows and you can see, okay, call prices in these names are pricing in better movement in the future, you can start to glean which names bigger funds in theory think are going to win, right? Because they're positioning in those specific ways. And the same thing works with these stocks, right? Where you see Microsoft now starting to catch a little bit of a bounce, Shopify moving a little ahead, Zoom clearly, these aren't super bullish things at the moment. But you compare that against something like Palantir. Palantir can't get off the deck, right? So the idea that Palantir has something special here, seems to be a little bit of a stretch. So those prices are definitely forecasting much more relative bearishness versus something like a Shopify or a Zoom.
Well, Brent, thank you for doing this. It's always good to see what's going on behind the scenes. I mean, we see the headlines, but this is what people are actually doing with their money. So it's always great to see it.
Yeah, thanks so much, Jack, and congrats again on the show.
Thank you.
Next up, we have Ben Hunt from Epsilon Theory and Prescient. What's really great about this commentary from Ben is he's going to talk about how it's just another boom bust cycle. The Citrini piece is there. It matters. It affects. It's moving the narrative. But we do have a credit boom bust cycle that's underway. There's an update about private credit in here. And make sure you pay extra attention to this anecdotal story he has from this trip out to San Francisco, meeting a consumer-facing company founder, and what happens when they couldn't renegotiate their terms. This is my clip with Ben Hunt. Up next, we're joined by Ben Hunt of Epsilon Theory and Prescient. Ben, welcome back to Excess Returns.
Great to be back. Thanks, Matt.
So Citrini, we've all read this piece. You've been writing and you've said recently you don't need an AI apocalypse to break private credit when a classic, good old-fashioned boom-bust credit cycle, that'll do, especially if it's hypercharged by 15 years of ZIRP and liquidity. Explain the nuance here.
Not much of a nuance, right? It's just that I like the Citrini piece. And just to recap for the people, the 5 people who haven't read it out there. But the idea is that, okay, if the AI eats the world, by which I mean does all the software jobs in the world, does all the white collar jobs in the world. And honestly, I think there's a more than a small grain of truth to that. I think it's going to have an enormous impact in those ways. Well, if that happens, then the software companies, the consultant companies, all these private companies that private credit has been lending money to, well, that's a problem because there'll be defaults. They won't lend the money back or they won't get the money back. And well, that's not good. That's not good. So I get that. I don't think, though, you need to imagine an AI apocalypse for that dynamic to take hold. So on the one hand, I'm both, I guess, maybe even more pessimistic, if you can imagine such a thing, than the Citrini bit, but I'm also less apocalyptic than the Citrini approach. I think we've got plenty in just a hypercharge because of everything that's gone on over the last 15, 20 years. But I think the ordinary boom bust credit cycle of financial markets can do most of the work here.
And to that extent, like we just saw the Blue Owl news, we're seeing UBS post these numbers of 15% potential default rates. Are we just sort of like working through that part, kind of like we were in 2005, 6, 7?
Well, yes and no. I mean, we're not in 06 anymore. We're in 07 going into 08. And what I mean by that is then we were talking about defaults in homes. Here we're talking about defaults by companies that have borrowed money. Back then we were talking about homeowners defaulting on their mortgages. What's similar, though, is that in the same way that the contagion spread, remember that was Bernanke's famous line, that subprime is contained, not just contained, well contained.
Ring fence around it.
It's just the poor people who are having a problem with paying back their loans. And when that proved to be not true, that's when the debacle really began. Because loan books are set up to withstand some defaults. I mean, maybe 15%, like UBS saying, that's a lot of defaults. And to get to 15% defaults, it can't just be from one little corner of the world. It has to be much more diverse sources of defaults. So in that sense, what's happening with AI and putting stress on software companies, which make up a big part of the private credit world, it's meaningful, right? So it's more than just working something out. What everyone is trying to figure out is how bad is the spread? How bad is the contagion from all sorts of different sources? And what I'm saying is that the excess of lending by these alternative asset managers. We used to call them shadow banks. We don't call them that anymore. Of the excesses of that and the way there's been structured and levered in different, what are called BDCs or CLOs. It's another kind of alphabet soup, the same way we had around mortgages being levered and structured. It's that, right? It's that makes for a bubble that gets popped. It's real world rising and falling and companies doing well and companies going bankrupt. That's kind of normal, right? And so you get normal market responses from that. The bubble inflating is when Wall Street, which Wall Street always does, because it's what Wall Street does, when you take that cycle and let's ramp it up to 11. Yeah, let's turn it up to 11. That's what's been going on. And that's why I say that even kind of normal default cycles, which we haven't seen in a long time, that's bad enough. But against this backdrop of leveraging, and which just means borrowed money, and structuring, which just means different ways to sell it to different people, I actually still think it could be a lot worse than people are even thinking.
You put this in a pro note that went, and if you're watching this and if you're not subscribed to pro, this is your invitation. Go.
Thank you.
Epsilon Theory, check out pro, look at the service, because you get stories like this in your inbox with all this data and way, way, way more. So I want to pull a story out of the pro email from today, which is you were just on this trip to San Francisco. And I know this is an anecdotal example, but this is a really powerful anecdotal example of what's happening at this frame in the cycle. Tell me what the experience was. Tell me the story.
I haven't been to San Francisco in, 4 or 5 years. And so it's fascinating. So right now in San Francisco, there's an energy and a vibe to San Francisco that I haven't seen since .com. There's a belief that they're building something is important. So it's the technology, everything you hear, I think it's real. At least people really believe it. And yeah, I got a chance to have dinner with a old friend of mine. He's been the CEO of a consumer-facing online company for a couple of years now. And this is one of those companies that was bought by a private equity group that is part of, I'm not going to go into all the details, right, to maintain some anonymity here. But the private equity group is part of let's call it a name brand Wall Street firm. And so they bought this online company, and then they do what you do. You borrow money on it, and you're borrowing a lot of money because you're basically borrowing it close to 0% interest rates. That's the playbook. And you borrow the money, and it's fine. And the company is a good, solid operating company, makes enough in cash to pay off the debt until you've got to refinance the debt. Because today you can't refinance at as low an interest rate as you could 4 or 5 years ago when they took out all these loans. Now, what often happens in these situations, it's not like, oh, you're a homeowner, and so you're going hand in hand to the bank. Please, bank, can you give me a better deal on this mortgage I need to refinance for whatever reason? Or you bought a new home. Can I have a better rate than you're giving the rest of people? No. You get what the bank offers you. Well, in this case, this often happens in this sort of world. The private equity guys from the name brand firm said, you know what? We're just gonna steamroll the lenders, right? We got to refinance, but they'll give us a ton of breaks because we're a name brand firm, right? And these are just some, who knows lenders. And besides, what are they going to do? They're going to call us on this. They're going to force the company basically to default. They're going to force a workout. They're going to take possession of the company. Come on. You know, they're a lender. They're not going to do that. Well, they did. The lenders didn't blink. They weren't going to give them a big discount. And so the private equity said, well, okay, here are the keys. And so the result of this is, you know, the company will survive. It'll just get downsized dramatically. It'll be managed to throw off cash. Won't be growing. It'll just be boring and basically in runoff mode. They'll just get what they can out of it. Obviously, nothing left there for my friend, so he's going to find something else to do. But there comes a time in every credit cycle where the money, the lenders, the investors, where they say, no more. Where they get skittish about whatever. Maybe it's the economy, maybe it's AI's coming, maybe they think there's some threat, and they say, you know what? I would rather take a manageable, certain loss today and move on than re-up for more money that could be potentially existential loss tomorrow. Every credit cycle, this happens, where the money says, I'm out. I think that's where we are. I think that's where we are in this. And there are lots of reasons for it, and there always are. AI is going to, you know, undermine the ability of these companies to make as much money in the future as they've done in the past. You know, the consumer is really stretched. And so we don't want to lend money to these companies that are facing a stretched consumer. All these reasons, and they're all true. But what's really true, and this is what I mean by it's the constant boom bust credit cycle, is that we had basically free money for a long time. And then the world just awash in money. And now that tide's going out and the cost of capital is going up. And this is what always makes people with money say, I'm out. That's what I think is happening today.
Ben, people want to see some of these themselves. They want to track this along with you. Where do you want to send them?
Go to Epsilon Theory. As you say, go to Persient Pro. And this is what we do. We try to track the stories. And this is one of the biggest stories out there, when the money says no.
Thanks, Ben.
Thank you.
Rupert Mitchell, Blind Squirrel Macro, always with the counter takes. He does a little bit of an intro game. I want you to appreciate that with me. He's slippery when wet, that squirrel.
Did he turned it on you, the intro?
He flipped it on me, man.
Oh, he did. That's the first
came
person
in-
that's done that, right?
He came in hot. Caught me off guard. Made me on the fly have to think of a bunch of Bon Jovi jokes. I'm always there for that. So Rupert goes through not only the standard chart that he always shows us, the S&P relative to the rest of the world, but then he talks through, Rupert was one of the guys early on this software story cracking. So now he's looking at the software stocks after the come down and saying, well, this happened quicker, faster, and farther than I had predicted on the heels of this report. What's likely priced in? Should I be bottom fishing here, or what's going on in the rest of the world? Spoiler, he's very intrigued still by where this is settling out outside of the U.S. right now. Rupert Mitchell, tell us something smart. Rupert Mitchell, Blind Squirrel Macro, welcome back to Access Returns.
Hey, Matt, I've got something for you. I'm on with the pinnacle of Pennsylvanian planning and the John Bon Jovi of financial joy casting.
This is
what
I'm here for. Well, if anybody ever called you a midwit of FinTwit, you're ready to defend the mid curve, because you're ticking some people off this week with this whole idea that, you know, we should just be. Don't you know you throw the babies out with the bathwater? You were early on the. Paint the picture on what you saw early on the software companies, and then tell us where we are now, because you kind of said this was at risk. Now it's happened. Now you're diving in and researching and revisiting some of these names. What's going on with software? Why are you mid-curve and defending it?
Well, I first started writing about the impact of AI on SaaS businesses a couple of years ago, right? And started getting much more aggressive about it in the last 3 and 4 months. And it's worked very well. And I saw a sort of snarky tweet on Twitter yesterday, who basically using the classic mid-curve meme. And the topic was Adobe, left quadrant, Adobe's a cheap stock, right side, Adobe's a cheap stock, and mid-curve, i.e. me, in the middle. And so I go, you know what? Okay, I'm gonna red team myself. So that's what I'm working on this week. The sad thing is I'm doing all the work. I'm pretty comfortable that, it's trading at 4 times EV to sales now. I could easily defend, right, a multiple that's half of that, right? So potentially got a long way to go. And, should we look at something like Photoshop and Premiere Pro and Acrobat as interesting sort of potential annuity businesses that could be owned inside some kind of evergreen capital vehicle? But it ain't worth $100 billion. The ticket for that is a lot lower. So I'm doing the work on this, and the irony is not lost on me that, it probably doesn't make a huge amount of sense. Adobe is a sort of, as a funding short, it has moved aggressively from here. I could, the argument really is sort of passive aggressive indifference towards names like that, really, rather than trying to sort of stay in the arena on the topic. And you wonder why I'm spending a week of my life doing this instead of looking for cheap stocks that are going to go up internationally, because that's really what's working.
Well, let's talk about that. You are also writing about this round tripping since Liberation Day, basically, of U.S. stocks relative to the rest of the world.
Yeah, so my favorite chart of truth that we always talk about is just the ratio chart of the SPY versus the MSCI EFA, and the ETF ticker for that is IEFA, so it's SPY versus EFA. And, up to Liberation Day last year, the SPY chronically underperformed international stocks. It then retraced a classic Fibonacci retracement where it hung around for about sort of 5-6 months, and we're now below the Liberation lows. So, I see all the debates about how real or not real the great repatriation trade is, but the chart's pretty clear, and it's not all the currency move.
How do you stack that up now to explain not all the currency move? And I'm particularly interested in where you think this is going from here.
Well, I have a bias for a weaker dollar generally, but that's become a consensus view that normally would bother me a lot, but I actually see how it benefits everyone, for the dollar to weaken slightly. And while they can't say it out loud, this is more suited to achieving the administration's aims. Having a weaker currency, it's just not good for the ego. And meanwhile, real or not real, I think marginal dollars are staying at home in less liquid indices and that are cheaper, and there is a kind of forced re-rating going on. And you've got the rest of the dirty little secret is that equity markets go up where governments are spending money, right? I mean, that's the reality. And governments are spending money all over the world now. And it used to be a sort of unique achievement by the US. So, I mean, I guess Japan's the poster child for that. China's going to have to carry on doing fiscal. And they are now cheerleading their own equity market as well. That's a double winner. And there are plenty of reasons to be excited about a Europe that's starting to spend money properly.
In the wake of all this, where's gold fit in?
Listen, I think gold has really stomped its supremacy in the last 18 months. And I wrote about the gold miners last week. I mean, I joked that I've turned into my dad. My friends and I always used to tease our fathers about poring over financial newsletters about junior gold miners. And now I'm doing it myself. So, I actually wrote a really long piece talking about mining beta, talking about how, just owning the ETFs, you really need to know what you're owning, particularly as you think you're diversifying by owning some seniors and juniors of silver and gold. And actually, there's so much cross ownership across those ETFs. If you do what I did last year, I basically bought a silver fund unintentionally. So I tore those apart and put together my own bespoke basket, really to leverage on expertise of professionals, right? I believe in team expertise. And so I looked at what are the active managers, specialist mining active managers, what do they own? What do the major sort of gold newsletter writers like Fred Hickey and put together a basket that lent on their expertise, lent on what I call sort of institutional beta. At some stage, big grown-up active management is going to reach for the miners, and there only are about 4 or 5 stocks that they can own, right, in large portfolios. And again, if you just owned the 4 mining ETFs, you'd be chronically underweight in the likes of Newmont, Agnico Eagle, Barrick, Alamos. Although you don't want to own Barrick because they gave up the gold ticker. Idiots.
They had it right there in the palm of their hands. And do you really, and this is really fascinating. So this is Blind Squirrel Macro. You can check this out on the website too if you want to read this whole piece. You still see a lot of room for this to continue as that flow story evolves, especially around these names.
Yeah, I really do. I think it's more than just a flow story. These stocks are still incredibly cheap. And, if you think that a global all-in sustaining cost for gold is about $1,500 an ounce, right? These balance sheets are in great shape, so they're not going to dilute you to death. The margins are just amazing. If you compare multiples versus the last gold peak back in 2011, the miners are trading at massive discounts to the broader market versus to the premium that they were trading at, 15 years ago, or back in 2011. And I'm not worried about the price of the metal itself coming down to challenge the all-in sustaining cost. When we're in a world of $5,000 gold, you also don't have to worry about conventional anxieties like the oil to gold ratio, right? So let's take that $1,500 AISC, right? Let's jack up energy prices by 20 to 30%. You're really only impairing margins at the AISC level by about 5 to 9%. So you can't get sort of punctured beneath the waterline by a spiking energy price, which is good news because I actually think I'm back in the energy bullish camp, right? I'm not in the WTI 250 baseball cap world, but I think we're going to see sort of generally rising energy prices over the next couple of years.
Well, you, sir, are a cowboy from this John Bon Jovi. On a steel squirrel you ride. Rupert, where people should look you up? Where do you want to send them?
BlindSquirrelMacro.com is the easiest place to start. And send me a message if you want a trial. I'm not putting a button out there that you can just blindly press and then ignore. But get in touch with me and I'll put you on a trial.
Between the software stuff and the gold miner stuff, you want to check in on this work. Rupert, thanks for joining us.
Thanks, Matt.
So I think, Matt, whenever the world is saying this time is different, I can't think of anybody better to talk to than Meb Faber, because nobody has better data to look at that situation, I think, than Meb, and especially what they're doing with the idea farm.
Especially with the idea farm, because it's always a survey. Back to what we were talking about at the beginning, risk means more things can happen than will happen. One of the great populator of my base bull and bear cases is leafing through the idea farm and getting a bunch of different takes from a bunch of different outlets. So I love that Meb's doing this for us.
And that's what we did. We picked 3 of the articles they've highlighted recently. All of them are around this same theme of this time is different. We've got a Schroeder's article. We've got Grantham's new AI piece. So here's Meb breaking that down with me. Meb, welcome to Last Call.
Great to be here.
When we came up with this idea, you were one of the first people I thought about because we're trying to do the opposite of what like a normal market wrap would do. Like, here's what the S&P did this week or something like that. We're trying to highlight great research. And I think the Idea Farm, in terms of like the quality of the research you guys find, I think is the best site out there. So I would recommend anybody take a look at what you're doing. It's theideafarm.com. You guys always find papers that I can never find myself. Like when we did our episode on 22 market wraps, we wanted to figure out like what the consensus was for the year. So it's like we read 22 market wraps, so you don't have to. We just went to the Idea Farm and you had 22 market outlooks for this year, and we just found them all and we read them. So
the cool part is we've now built out an archives, so it actually has all the research pieces we've sent out going back a decade, and we're going back year by year. So we should be done with that project by July 4th. We have all the top podcasts, some of yours that we've sent out over the past 10 years. So it's all searchable. You can kind of dig through. So if you're looking for a master's in investing, skip the MBA, y'all. Just go hang out on the Idea Farm and download a bunch of those pieces. Listen to this show, get you all the way there.
Yeah. And we're going to talk about 3 pieces here, and I would recommend everybody read all of them. And they've kind of got a similar theme here because this idea of is this time different is one that's I would say out there right now. And we've got 3 different pieces you guys highlighted. One's called Decoding Markets, So Obvious It Hurts from Schroeder's. One is Bayes and Base Rates from Michael Mauboussin at Counterpoint Global. And one is the Grantham piece on Decoding AI, Extreme Bubble, New Growth Era, or both. And they kind of have similar conclusions in terms of this idea of, is this time different or is it not?
You know, I think the struggle for so many people is they want to end up in one camp or the other, right? You have all these perma bears out there, the sky is falling, doom, the stock market's super expensive, everything's going to crash. And then you have the, optimists on the other side. We're going to do 20% returns a year in the stock market, on and on. And as an investor, who's studied history, not just 10, 20 years, but 100, 200, 300 years, you learn these various cycles. And there's this constant push and pull of how do you participate in the boom, but protect yourself in the bust. And so I think all 3 of these pieces give good historical examples, good frameworks on how to think about that. And we can dig into each one and kind of talk about it now.
And that's the challenge, right? Because these things are so hard to time. So it's easy to look back at all these charts and say, oh, it was obvious the way it was going to end. The problem was it wasn't obvious when it was going to end.
Yeah. And so if we start with the Schroeder's piece, which Schroeder's consistently puts out some pretty good charts, they go through like 3 or 4 famous periods globally in investing, and they stick to stocks that had a boom period. So Nifty 50, which was the late 1960s, amazing period. A lot of names from our parents' generation, GE, Coca-Cola, the old phrase, nobody got fired for buying IBM, right? All these just blue chip stocks you bought, you put them away, you didn't have to worry. Well, that was until the 1970s when you had high inflation and all of a sudden stocks got pummeled. These high multiple stocks got re-rated, and other things like gold did well, or things like value stocks. So you have this sort of rinse repeat. I mean, the granddaddy we love talking about, I was just over in Japan, was their boom in the 1980s. I mean, my goodness, what a monster run. Japan was going to take over the world. Nintendo, Toyota, Panasonic, and their stock market, I think, is in terms of size and scale, was the biggest bubble we've ever seen. I mean, the PE ratio was double what the US had in the late 90s. And then, of course, we've all seen, everyone loves the example, now do Japan. The 3 decades since, stocks were stinky returns in Japan. Now they look good now, but that's an entire generation, 30 years, of people that, got burned trying to buy Japan after that bubble burst.
Put up this chart figure 8 here, which is all of them sort of combined. Like they looked at Japan, they looked at the .com, they looked at China. Like, what do you think are the biggest takeaways when we look at this? Like when you analyze these all together?
There's always the diagnosis and then what's the prescription. And most of the financial media spends all the time on the diagnosis. Stocks are expensive, right? Or it's dangerous. But the reality is, if you look at some of these charts that had hundreds, thousands of % returns, you could have said that along the way. So to me, there's kind of 2 prescriptions that are thoughtful and will keep you in the game. The first one is just have a diversified portfolio, right? Most people don't. They're all in on US stocks and bonds. So having global stocks, global bonds, global real assets is a great starting point. Second is strategically rebalancing. That means always trimming your winners, buying your losers, hard for people to do, but it keeps you kind of coming back to being at least a little thoughtful. And the last one, which I think is a little harder for most people, you can buy funds that do it. We manage some, is trend following. Trend following at its core, its goal is to try to stay invested during these really long moves, but at some point say, you know what, it's time, I'm getting out. And I think one of the added benefits of trend following is not just missing out on these declines that are, in many of these cases, 50, 75+%, right? Like those are tragic terminal declines for many people. Being able to sit those out, but also trend following often gets you invested in what we call the right tail, things that you may not invest in, like foreign stocks or gold or silver, on and on. So there's some prescription, I think, like those steps in order for most people can help you as opposed to listening to your neighbor, as opposed to saying, I can time the top of this. I know when I'll be able to get out musical chairs. That's the hardest of all of them.
So the second piece is the Mobison piece. And anytime Mobison writes anything, like I'm pretty much immediately dropping everything and reading it. And this idea of base rates, flows through a lot of his work. And it was interesting. And I'm going to put up these two charts here, but he looked at OpenAI. And it's interesting because OpenAI is growing at an incredibly rapid rate right now. And I didn't even know this, but like the market expects OpenAI's revenue to grow 100% a year between now and 2029. But what Mobison did is what he often does. He took the outside view and he said, of all the companies that are, billion-dollar plus revenue companies, how many of those have been able to grow revenue at 100% a year over this period? And it's an interesting way to take a look at it and maybe challenge the view from the inside that the company's going to grow that fast.
If I could tell you how many startups I've seen that claim to be the fastest growing fintech of all time, there's like 1,000 of them. It's like you always see these statistics and information as an investor. You look at it and say, okay, I see this projection. Maybe it'll come true, but how do I gauge this? What is my framework? What is my anchor to compare this to what's happened in the past, right? And so Mobison, the cool thing he's done across thousands and thousands of securities to say, okay, let's classify this company, this stock, this market cap, the sales. Here's what it looks like. And here's other companies that have looked similar in the past. And how often does this happen? Is it a coin flip? Is it likely? Is it unlikely? Has it never happened before, right? And so then at least you have a framework of saying, okay, I can make an educated bet on this outcome. It's like a football game, right? If your team's down, Broncos are playing the Raiders and the Raiders are down 40 points and it's the fourth quarter, you're like, well, this has probably never happened before where someone's come back by that amount. Probably not a great bet, even at 100-1. But, and you can compare it to all the times in history. And so what he finds, not surprising in his paper, is kind of unlikely that, OpenAI and Oracle and some of these are going to hit these targets. It goes back to some of the Cathie Wood, projections on GDP and, the funds doing 50% a year. You kind of take a step back and say, that sounds great, but is it likely? And it goes back to kind of the Dumb and Dumber movie. There's a chance, but not much one.
Yeah, I think it's great because it makes you ask the question, if you have one of these forecasts, like how much confidence do I actually have in my forecast? Because it doesn't mean it's impossible. Like if we had put up this chart of the base rate chart before the Mag 7, when they were smaller companies, they've blown onto the right side of this chart. Something that wouldn't have been impossible, would have been very, very low probability. But if I'm projecting that for a company in the future, I should at least have the context to say, in the past, how many of companies that were in a similar situation, how many were successful in doing this? And if that number is exceptionally small, I need to have a high confidence in my forecast.
Imagine, we did this on Twitter not too long ago. JP Morgan has a nice chart of world market cap over time. And so going back to the Japanese example, Japan was a majority. It was the largest stock market in the world in the 1980s, bigger than the US. Okay. So not that long ago in our lifetimes. And I go, imagine going back to the 80s, Japan holds the crown, US is number 2. And imagine telling someone, say, in 30 years, Japan is going to go from whatever the number was, 40% of world market cap to 5. And the US is going to go from 25, 30, whatever it was, to 2/3 right? People would be like, no way, like no chance, like what happened, right? But you take a time like today and you say, okay, well, what's most likely to happen? Like, can you fathom a scenario where US goes from 2/3 to a quarter, right? You're like, oh my God, that sounds like what happened, a Great Depression or something. Well, a quarter is US GDP, right? Currently of the world, right? So it's not that out of the ordinary. So I think the challenge for investors is at least fathoming the outcomes, because we all know with investing, with life, with relationships, with anything, it's your expectations versus what happens, right? When you have this like, oh, this is definitely going to happen. This is the total outcome. I'm completely confident. And then that doesn't happen. That's where the fractures, mental, emotional, psychological, happen. And a lot of times, particularly with, investing, think back to 2009, people said, I can't take anymore. I have to sell everything and then never get back in. It can be traumatic.
So we won't go through the whole Grantham piece, but there was one chart I wanted to talk to you about because it's really interesting to me. And this idea of the number of companies trading at 10 times sales. And I didn't realize that, but we got above the .com in terms of that. And yeah, going back to Mobus's work on base rates, like the base rates in terms of a lot of things are not very good for these companies that trade at 10 times sales.
It's fun to look back at a lot of the historical bubbles because you see so many commonalities. I mean, the Grantham piece, they talk about RCA. Nobody's talking about RCA anymore, but they talk about how that stock went crazy. They talk about UK railways. Professor Schiller has a great old paper that he looks at the sector CAPE ratios during the 1920s and how people went full easy for railways back then and utilities, right? Imagine get all hot and bothered about railways and utilities. That's the boring part of the monopoly board. Like nobody wants those today, but we'll look back at this period and probably say similar things. And I was laughing at the Schroeder's piece because it was talking about the Nifty 50 period. And like, people were crazy. They were paying 30 to 50 times earning for some of these stocks. And I was like, well, today it's not 30, 50 times earning. It's 30, 50 times sales on some of these. And so when you look at, for example, the percentage of the market cap trading over 10 times sales, I never thought I'd see something like the late 90s again. And here we are, not too far into the future. So it's kind of priced for perfection. Now, all this having been said, the US market's still sort of floating around all-time highs, but you've seen this massive rotation over last year, this year, into other things particularly being foreign stocks, foreign value, gold, precious metals. And then this year, it's even rotating into things like small cap, value in the US, basically anything other than market cap weighting. There's an interesting piece recently on Twitter from D.E. Shaw, where they were talking about, everyone talks about how expensive the market cap, the big names are. What no one talks about is how volatile they are. They're actually much more volatile than the market, which is interesting. I'll leave you with one more thought on this topic. As we look around the world, my least favorite phrase is the easy money has been made. You hear this on CNBC all the time. They're like, the easy money has been made. And I'm like, bro, there has never been easy money been made in markets. In fact, I just use the opposite. I'd be like, the hard money has been made. So when you look at like global deep value stocks last year, up 50, up another 15 to 20 this year, I say the hard money has been made. And people are like, what are you talking about? I say, well, who owned those at that point, right? Because if you own deep value stocks, ex-US, that meant since 2009, you underperformed year after year after year after year after year after year. I could keep going about 5 more years, right? So the hard part was holding, buying, re-upping. I actually went on CNBC and Bloomberg a couple of years ago, and I was trying to make this example. And I say very quietly, look, I love y'all's TV show, but all you do is talk about NVIDIA all day long, NVIDIA, NVIDIA, NVIDIA. And as you should, like record profits, execution at this scale is astonishing. Maybe the world's first $5 trillion stock. We'll see. But I said, how many times have you guys mentioned the stocks Hanmi Semiconductor? And they're like, what are you talking about? Did you just sneeze? Like, what are you doing? And I say, well, this is another semiconductor stock that's outperformed NVIDIA over the last 1, 3, 5 years. But it just happens to be located in South Korea, right? Like nobody's paying attention because it's somewhere else. That stock has been like, I think a 20 bagger or something, but very quietly, right? Like no one's. So when you look at kind of a lot of these trends, if we did this show a year or two ago, I think, we were still in this like to the moon forever period, but very quietly underneath the surface, you're now seeing the rotation into lots of other things. So maybe the bull market and diversification has begun.
We're hoping so, at least those of us that are value investors. We weren't able to get into a lot in these papers. They're all really, really good papers. So I'd recommend theideafarm.com. Check it out. There'll be new stuff every week. You can get the email. And thank you for doing this.
It was great.
Now that we've heard all these arguments on both sides of this, now the question is, this is going to play out in the real world. How do we think through it? And I think one of the things I'm thinking about is, like, what would I look at? Like, what would I see in the data to tell me how this is playing out? So I don't know if you have any ideas, but I'm thinking about like what I might follow going forward to see if anything close to this Citrini thing is playing out, or if we're getting a completely different version of the world.
So I think what's really interesting is I haven't heard the conversation you just had with Kai. I'm very, very excited to hear that conversation because I'm curious the way we can actually look at corporate filings and further understand, because Kai's already been on top of this with some of the intangibles work. How can we understand what companies are actually doing and pinning to their use of AI? So their upkeep of AI, the percentage of spend, the percentage of return that they're getting on that spend. I think corporate filings are a major, major, major one. What about you? What are some other areas?
No, that's a good, by the way, because that didn't come up as much in our conversation as it should, but Kai does that. Like, Kai does a really good job of, like, our previous conversation with Kai, we talked about that. Like, he's looking at what people are saying in their filings in terms of actual ROI with AI. So that definitely would be one thing you could look at. We pulled stuff for our conversation. A lot of it was from the Citadel piece, and Citadel took the other side of this, but they were looking at the types of things you might look at if you wanted to say, like, is this playing out the way the Citrini thought? And one thing you would look at probably is some degree of AI adoption. And this is something Kai and I like push back on a lot in terms of the article, which is, like, there's one thing about the pace of growth of a technology. There's a totally different thing about the pace of growth of adoption. Like, just because the technology is going crazy and growing at a rapid rate does not mean that my dad is going to let an AI agent make his purchases. Like, that's a long way away. And so I think it's important to look at both of those things, like not just what the technology is doing, but also, or like whatever the new model can do relative to the old model, but also, like, are people actually using it, and are they conceivably going to use it the way it was phrased in this piece?
It's a very interesting nuance as a part of it. And I see a lot of things on the product adoption lifecycle curve where they're saying this probably doesn't grow and scale in the same way, because we might not end up in the scenario where your dad is using it, or they might be using it, but in the basic chat GPT way that we see people using things now, where it's like, where do I go to lunch when I'm on vacation? That's very, very different than the enterprise software decision to drive, how do we recode the CRM for our entire department?
Yeah, it's very different than what was in the piece, which is this idea that basically AI is taken over as the buyer of choice for everybody. And it's like this low-cost buyer, and so that it's just deciding what to buy for you. That seems to me like that's a long way away. Not that the technology might not be that far away, but your average person agreeing to let that happen is probably a long way away.
So also interesting inside of this is on the employment data side. And I think Eric Packman at Data for the People has been doing an exceptional job of this, because he's been flagging this already. Before any of this came into the picture, he's saying, look where we're shedding jobs. And in a lot of places, we were hollowing out some of that white collar market. I'm not saying that's definitely going to continue, but I think that trend has already started in the data. If you're looking through the BLS statistics, if you're looking through the survey data, it'll be interesting to see if that continues and goes to what depth. He's got some tools on a national, state, even town and local level where you can drill in and see, like, which jobs are going in which directions for people losing jobs, filing for unemployment or not. Lots and lots of wrinkles inside of this, but this might be the great fourth turning wealth distribution that we've been promised. I don't know.
Well, it's funny too, because I'll put the chart up, but Citadel cited this Indeed job openings thing in software, and they were showing, like, actually, like, software jobs are going up right now. And, like, when I got on with Kai before we recorded, he's like, that's a massive chart crime. And I'm like, wow, it is. And he's like, he went to Fred and pulled the whole thing. And basically they had just centered in on, like, this recent period. But if you take the data back to 2020, it's like this massive peak in software jobs and then, like, this huge move down, so there's nothing to do with AI in there. Like, it hasn't gone up or down because of AI. Like, it's barely moved at all, but it lost the full picture of the entire thing, like, since 2020.
We do a decent amount of work with clients in and around this space and the tech sector and software jobs. And we talk to enough people in this space to have a feeling. pre-COVID, so like 2019 to 2023, you basically had this massive hiring boom in these areas. And even with seeing some of the early layoffs and whatever else, it's like we're doing an adjustment off of a massive base where we had a giant multi-year hiring boom that followed by like a flattening to a slight decrease. But it was like they were hiring in that sector like 2 to 3 times the national average of additions for 4 years in a row. And then that kind of petered off. And now some of those like people being let go or the adjustment on back up where there are openings at a handful of companies. It's very disorienting if you're not zooming.
Yeah, so I think the reality is that data is telling us absolutely nothing about the Citrini thing one way or the other. And I think that's true of all the data right now. We were talking before we recorded, like productivity, just the ability to measure productivity, like in the internet technology-based world. Like when we talk to Jim Paulson on the Jim Paulson show, he's talked to us about like, he thinks that data is, basically useless now. Like the productivity data is not even valuable. So, and also, by the way, even if it is valuable, like go pull that up on Fred. It's basically a straight line across. It's bouncing up and down. Like there's nothing there. So all this is backward looking. There's nothing in the data yet, I think, to indicate that we have this type of scenario playing out other than, what Jack Dorsey did yesterday. I mean, that type of thing you're starting to see. And whether you see more of that is probably important in terms of figuring out what might happen.
Jack Dorsey's another case, though, of where they had a massive hiring boom and then they held the line and now they're finally letting some people go. There's also a really weird stat about some corporate party. It looks like some multi-million-dollar corporate party. People are like, how do I get invited to that event? I'd like to know too. But some of this is just normal corporate behavior. You overhire in a boom and then you cut back when something gets tight. There's a lot of wanting to read through onto the exact reasons for this decision. And much like every time we talk to you talk to a Brent Kochuba or you talk to a Kevin Weir or any market maker, it's like, yeah, somebody's kid was sick and they weren't in on Monday for the rebalance and some stuff happened. Like that's all part of this here. I want to ask about this one to you too, just in case you saw it in any of the other conversations or stats. It doesn't feel like we had a lot with the CapEx build out and basically like the energy boom. This part still really troubles me on just the inflation stats of like AI data centers as a portion of electricity consumption are like mid to high single digits heading into double digits by all the projections in the next couple of years. It's like we still need to spend and burn a lot of energy and get a lot of compute to get anywhere near this scenario. It feels like
it's like
that is, you got to move.
It's like you need the de-inflation to get the deflation, right?
You
like
need a
idea.
lot of inflation to get the deflation, and you need a lot of compute build out, and you need a lot of energy consumption. And it's not clear that we can get even all the way to the stage where that's feasible in the next few years, outside of inventing nuclear power plants or putting solar farms in space, which I'm sure that'll happen soon.
And by the way, Gavin Baker's really good to follow on this too. Like he was one of the people who, he didn't attack the Citrini piece, but he did say like, there's just not nearly enough compute for this to happen on the type of time frame they're talking about. Like even if this could happen, like we're not going to have compute for like a very long time for something like this to go on.
All right. That was you answering my question. I think it's time for us to leave the office, get back onto the private jet. We got to get down to the Caymans, check out on how all of our undisclosed positions and things. I shouldn't even say that.
Now you're making me think I got to make a private jet video of us getting back on to put at the end. It took me long enough to make that one to get us getting off.
We need the closing video where we get back on, wiping the sweat from our brow. I like.
I do like that at least one person who we will remain unnamed. At least one person did believe the private jet, which is great. I think there's more out there. So
there's more out there who definitely believe it.
So it was worth all that time.
If you believe that video, I have a copy special of Jason Buck's book, Pimp of All, just for you.
We still get comments that people want to buy that book.
As they should.
They should. And the best way for that story to end is for him to actually write the book. Because that's how it has to end, I think. He had no intention of writing the book. You made the book up, but now he's got to write the book.
I'm holding my breath, Buck. I'm holding my breath.
Well, thank you everybody for joining us, and we'll see you next time.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.